Hello everyone, my name is Michael Lamott and I am the founder of ChartYourTrade.com, and our goal is to inspire millions of hardworking people just like you to take advantage of the stock market. And so today I want to talk to you about when to buy. Well, we can have a lot of ideas about a stock, and we find this stock and we want to buy it immediately, but it's not always the right time to buy. And the way to figure out when the right time to buy is, well, whether you're somebody that's looking to trade on a shorter term basis or on a long term basis, the way to find out when the right time to buy is by consulting a stock chart. And so I want to walk you through some of our rationale for a relatively recent trade that we had for our advanced reports model portfolio in Alibaba. And so let's take a look at that chart and dive right in. So Alibaba is a stock that was on our radar for a very long time, a very dominant player in the space in China, and we've been tracking this stock since its IPO, and we've been in and out of it, but in January and leading up to January, it started to form a new entry point, and it caught our attention. So let's take a look at the chart and see and walk you through what we were seeing at the time. So here's Alibaba's chart on both a daily and on a weekly basis. And so when we're looking for stocks, and we're looking at these consolidations and we're looking at chart patterns, it's important to look at the weekly chart first and then go to the daily chart. And the reason why is because the weekly chart is giving us a broader picture of what's going on with the stock or with the market or whatever it is that we're looking at. The weekly chart gives us that longer term view, and then we can zero in on the exact spot that we are going to buy on the daily chart. So looking at this weekly chart, we could see that Alibaba consolidated for a long period of time. It ran up toward the end of 2016, and then it began consolidating again, and it consolidated to the tune of about 22-23%. And so it started to form what's called a cup with handle. And this is by no means a perfect cup with handle. Typically, in a cup with handle, we see this U-shaped pattern, and the handle part is a small little consolidation prior to reaching the high of the pattern. So looking at this chart, it would have been before here, right? So let's draw it for you. So if this were just going to be a cup, it would be something like this, where the cup just meets the peak of the pattern, but that's not what happened here. It consolidated again down here, and you get this little handle, and it's pretty clear on the daily chart, but it's an imperfect cup with handle, because typically we want to see the handle be a little bit higher in the pattern and not, or at least above the midpoint of the pattern, and here it's below the midpoint of the pattern, so it's kind of like a tilted cup with handle. And that's something that we would really want to drink out of, but anyway, that's kind of what the rationale is. So we have this cup with handle. It's imperfect, but it's a leading stock. It's in a strong industry group. The earnings and the sales are phenomenal, and it's setting up and it's catching support. So let's talk a little bit about the chart. And let's get that thing out of the way. All right, so it caught support. It was catching support around this 40-week line. It broke back above the 10-week line, and then it started to consolidate right before earnings. And in general, we don't want to buy right ahead of earnings, or we typically avoid buying right ahead of earnings, because it's one of the most volatile times for a stock, and it could have a nice breakout or it could fall apart. And if it's very difficult to manage risk around that time. That's why most people avoid it. But we decided that we would buy right ahead of earnings because it broke out of the cup with handle. And it took out that buy point, and the buy point there was 97.90, and so we got in right there at about 97.80 when it took that out. Our stop on the position was going to be back below the 50-day moving average, and the reason why is because it gives you more cushion, and the 50-day moving average was only about 6% below our buy point. So that gives us protection not only from the low of the handle, which we would typically use if it weren't earnings, but because it's earnings, we were able to give ourselves a little bit more room. But it gives us protection from that green line, that 10-day exponential moving average. And let me make this a little bit bigger. So there's that green line, the 10-day exponential moving average. It gives us protection with the 21-day exponential moving average and the 50-day moving average as well. So there's a lot of layers adding protection to that pivot point. And so let's say that we didn't want to use that cup with handle buy point. Let's say that we wanted to use this buy point over here, which is a flat base, right? So it's forming this flat base after it breaks out. It was consolidating for over a month, and so we could have added to the position right there, and it broke out, or it was attempting to break out again. That breakout ultimately failed, but it was trying to do that on heavy volume. This consolidation here was on lower volume, and it would have been another great place to buy, and support was forming along the 21-day exponential moving average. You could just see these things form on the chart when you have these moving averages on the chart, and we're not just picking them out of the hat. These are spots where institutions of various sizes typically support a position. The 50-day moving average is the most common. That's where the big boys will typically go and support a position. But the shorter term moving averages, sometimes they're used by the bigger institutions, sometimes they're used more by hedge funds. But it's not just, individuals like you and me. We're not the ones moving the market. We're just the little fish that are trying to move with the whales and stay in their stream and ride this trend up. So we were able to get in back here in January when it made that initial breakout, and then stay along for the ride. And so far, let's zoom out on this chart. It's made a run of about 80% since the time that we bought it back at this pivot point way back here. So in general, a pivot point is going to be the high of a pattern. Just to go back and recap, generally it's going to be the high point of a pattern. And if we were just looking at this as a cup and it completed the cup, it would have been right over here, right around there at that $109 level. So we're constantly looking for ways to enter where it's going to be a lot closer to support, and Baba gave us that opportunity down here. Let me get rid of this mark, and we could leave that one there for a moment because I have another point. So rather than buying all the way up there, we were able to buy down here at this cup with handle pivot, and then it offered another pivot which happened to be the high of its own pattern, but it wasn't quite the high of the larger consolidation yet. So there's multiple ways to buy, and we're just looking for areas of consolidation, areas where price is going to be chopping around sideways after a run up. And it's that consolidation zone where the market's still trying to figure out, like, okay, is this going to be a stock that's going to move higher? Is there demand for it? Or are sellers going to be control and it's going to roll over and base out lower or start a new downtrend? And so that's why we pay attention to these sideways moves, and we just simply place a buy stop or a working order, if you will, right at that level and just let it sit and wait. And if it triggers, then we're in, and we knew exactly where we would get out before we get in, and we also know the exact amount of shares that we intend to buy, and so we're able to, in all that, we're able to identify how much we're going to risk, where we're going to get out if we're wrong, and what we're going to do, and what our plans are going to be if we're right. And for this particular trade, because it was intended to be an intermediate to longer term trade, we've just raised our stops all along the way and have kept them fairly loose. I believe our stop right now is still somewhere in the neighborhood of 145, way down here. So we'll be raising that stop up shortly, because now, if you notice, the 50-day moving average is catching up to this consolidation right here at what's the low? 164.35. And so once the 50-day moving average catches up and starts supporting that level, and that level becomes tested, we'll be able to raise the stop up there and not have to worry about being shaken out of the position prematurely. Again, we are, for this particular trade, because it's for the intermediate to longer term portfolio, we want to capture the bulk of the bigger move and not worry about, a 10% or a 15% correction. If we were, it would be much harder to sit through the entire trade. And so Alibaba's a leader. It's a leader in its space. It's leading the market, obviously. You could tell that not only just by the price action, but by this line down here. This is the S&P's action versus, or Alibaba's price action versus the S&P 500, the relative strength versus the S&P 500. And so this is telling us that Alibaba's outperforming the moving averages. So we need to stay strong. We need to stay long, stay strong with the stock, and continue to let it work and do its thing. So that's it for Alibaba. So I hope I was able to give you a little bit of insight onto when to buy. Thank you all so much for watching. I truly, truly appreciate it. If you have any questions at all on anything I said, please leave a comment in the comment section below and I will personally answer you. Also, take a moment, please like this video, subscribe to our channel to make sure that you receive all of our future videos. And thanks again for watching, and I'll see you very, very soon.